We've been discussing the various steps for auditing the purchasing process. We started out by gaining an understanding of the purchasing process and how it works. Next, we identified significant accounts and relevant assertions. Then we assessed the risk and material misstatement. And now we're going to evaluate the design of the internal controls for the purchasing function. So a great way to start this is by doing a walkthrough of the purchasing process. We're going to go from the initial request for goods and services all the way through to the cash disbursement, updating the accounting records. Okay, we're going to walk through this and we're going to ask ourselves at each step, when there's a purchase order, when there's a receiving report and so forth, has the client designed an internal control that, if it were operating effectively, would prevent or detect a material misstatement? Now, at this step, we're just trying to understand if there is an internal control in place. We want to identify any of the internal controls and understand them. Because in the next step, which I'll cover in the next video, we'll be testing the effectiveness of the internal controls. So right now, we're just trying to walk through the process, map out all of the internal controls that happen to be in place. Now, first, we're going to start with entity level controls. Okay, then we're going to move on to controls related to specific management assertions. But first, we're going to start with these entity level controls. For example, we are going to ask ourselves, we're going to do some research, we're going to talk to people at the company, and we're going to find out, does the audit committee play an active role? For example, if you say, yeah, the audit committee meets regularly and they're very concerned about internal controls and strong financial reporting. Okay, that's great. But if you say, well, the audit committee hasn't met in a very long time and I don't know how concerned they are about the integrity of this company's financial reporting, that would be a bad thing, right? So is the audit committee actively involved? Does management have written policies and procedures for the authorization of purchases? Okay. Now, whether or not those policies and procedures are followed, we'll get to that when we're testing the effectiveness of the internal controls. But we're just trying to understand, do they even have policies in place? Are they requiring authorized signatures when there's a purchase requisition, a purchase order? Are we making sure that only authorized people can make changes to the vendor information, things like address of the vendors? Does management have dollar limits for purchases? For example, you say like a lower level manager can only make purchases up to $2,000. Are they monitoring days payable outstanding? So we're going to think about these entity level controls, and then we'll get into more specific controls, as I said, for each management assertion. Now, what do I mean by internal controls for the management assertion? So let me give you some examples, and then I'll give you a more exhaustive list. One really, really important internal control with the purchasing function is a three-way match of a purchase order, a receiving report, and a vendor invoice, okay? What does that tell us? Well, management is making various assertions, okay, related to purchase transactions. They're asserting that purchase transactions actually occurred, that there was a real purchase by the company. And if you can say, well, look, we have a purchase order, we have a receiving report showing that we received the goods, and we have a bill from the vendor. That's strong evidence that there really was a purchase. It does not guarantee there was a purchase, because there are ways that employees could commit fraud. For example, they could steal some purchase orders, receiving reports, forge them, set up a fake company, and then have an invoice sent from the fake company. So it does, just because you have the three-way match doesn't mean there was no fraud and everything's fine. But that is generally strong evidence that there really was a purchase, and that there is an accounts payable. There actually is a liability that exists, that this is a real obligation of the company. So occurrence and existence assertions, we look for that three-way match, among other things. Looking at the dates on these different documents can tell us about cutoff assertion. Okay, was the liability recorded in the right period? Using pre-numbered documents, pre-numbered purchase orders, receiving reports, is going to give us evidence about the completeness assertion. Were all liabilities recorded? The company might have an incentive to understate their liabilities. Now, when we compare these documents, we can also verify authorization and accuracy assertions. Did the company receive the right type of goods, the right quantity of goods, and was it the right price? Okay, so those are various assertions that management is making. They're asserting that accounts payable exist, that they were recorded in the right period, that they recorded all the liabilities that they were supposed to, and so forth. And we want to, the auditor is going to go and try and verify these things. But first they need to know, does the company even have internal controls in place? Okay? Now, segregation of duties is a very important internal control, and you're going to see it when I have the list of management assertions and the different internal controls. Segregation of duties is going to come up a lot. Very important for the purchasing process. So again, I already showed you this before, but there's the 6 steps in the purchasing process, and what you don't want, okay, from a perspective of wanting strong internal controls, you don't want the same employee having responsibility for multiple steps here. Okay, if you do that, if you allow the same employee, for example, to have 4 or 5 of these steps that they are in charge of, that makes it easier for them to commit fraud. Okay, so you want to avoid that. That's what we're talking about with segregation of duties. I'll just give you a couple examples. So, for example, the same person at the company, the same employee, should not be responsible for approving purchase requisitions, actually doing the purchasing, and then receiving the goods when they show up. Why not? Why wouldn't you, like, what could go wrong, for example, if you allow the same person to do those 3 different functions? If you allow that, what could happen is this person could basically say, hey, yeah, we're requesting some goods or services, that then they go in and purchase the goods and services, and then they make the receiving report as if they received the goods and services, but maybe they didn't receive the goods. Maybe, so just because you prepare a receiving report in a purchase order, that makes it look like, oh yeah, we had a purchase order, we have a receiving report showing that we received 100 units of whatever it is. Okay, so we have this information, but maybe that employee set up a fake company. Okay, they set up a fake company, and so then an invoice comes in from ABC Incorporated or whatever, and that's a company that was set up by that employee at the bank. And we say, well, it looks like, because they were in charge of purchasing, receiving, they made a purchase order, they made a receiving report, they dummied all this up, they made all these documents to look like we actually received goods and services, but the company did not. It's just totally a fictitious purchase, okay? So that's, again, segregation of duties. Not allowing the same person to do all those functions could help avoid something like that from happening. Another example, segregation of duties, not allowing the same person to choose the vendors, approve payment to the vendors. There was actually an example you might have seen in the news not too long ago from when this video was recorded of a Netflix employee. So if you Google it, there was a Netflix employee who was taking bribes for basically sentenced to prison for taking bribes for vendors in order to give them business with Netflix. So now we've got these various segregation of duties. And now another important thing is custody of assets and custody of documents. By custody of assets, I mean the company should restrict access to valuable things like cash and inventory that employees could potentially steal. And by custody of blank forms, I'm talking about restricting access to things like blank checks, blank purchase orders, receiving reports. You don't want blank purchase orders and receiving reports just laying around where any employee can just go and take them. If you did that, an employee who was dishonest could steal a blank purchase order, forge it, make it look like the company made a purchase, then go and steal a receiving report, fill it out, forge it, make it look like the company actually received goods, then go and set up a fake company, send an invoice to the company pays it thinking, oh, we got a purchase order, a receiving report, similar to the scam I mentioned earlier. So that's just called a fictitious company scam. Right? So there's no actual purchase involved or anything like that. So you can't just leave these purchase orders, receiving reports, or blank checks, right? That the employee can just go steal and write a check. You can't just leave those things around. They need to be restricted to authorized personnel. Okay. Now, next, we're going to look at examples of specific internal controls for purchase transactions, cash disbursement transactions, and accounts payable. I'm going to show you a list of assertions for each of these, and then I'm going to talk about specific internal controls that a company could have for that assertion. So we're going to start out with purchase transactions right here. So I've got a list. Here's a column of assertions, right? So management's asserting that occurrence, okay, that this purchase actually occurred. And then again, it's the auditor's job to see, well, did it in fact occur, okay? But there's going to be internal controls hopefully in place, right? The auditor's checking to see, does the client have any internal controls in place to make sure that to verify occurrence, right? So the auditor is because if they don't have any internal control for occurrence, it could be that there was a purchase recorded, but actually there were never goods or services received. There actually really wasn't a purchase, similar to the fictitious transactions I was talking about earlier. So occurrence assertion, did the purchase actually occur? Completeness, were all the purchases recorded? Okay. How do we go about setting up an internal control to make sure all purchases were recorded? Well, one of the things that's very important, similar to segregation of duties, I said is very important, but also using pre-numbered documents. If the company uses pre-numbered purchase orders, receiving reports, then the company and the auditor could then go through and say, oh, wait, number 97 is missing. What happened here? Was there a liability that was not recorded, a purchase transaction that was not recorded? What happened? Okay. Also, the company should be taking pains to try and match receiving reports to vendor invoices. And now when we get to authorization, we're thinking about, okay, was the purchase even authorized? Or maybe the purchase was authorized, but not at this price or terms. Okay, so is there an internal control in place? Does the company have something in place to make sure that purchases are actually being authorized? Okay, so one thing they could do, and this comes back to the example I gave about fictitious vendors and an employee setting that up. So the company should ensure that there's only purchases made from approved vendors. So there should be a list of approved vendors, and not just anybody should be able to go and make changes to the list of approved vendors, okay? So then they show, some company XYZ Incorporated, they say, you know what, that's not even on the list of approved vendors. They go there, look into it, and see, okay, this is a fictitious company, right? Now, the accuracy assertion, was the price correct? Was the amount of goods or services that were purchased, was that correct? The vendor information, is that correct? Okay. So what things can the company be doing in terms of internal controls? Well, if they check the prices, they verify the mathematical accuracy on any purchase orders. The cutoff assertion, what kind of internal controls can we have here? Well, again, cutoff is just basically saying the purchase is recorded in the wrong period. So what the management of the company could do in terms of internal control, the receiving reports. Remember, when a receiving report comes in, the company's received the goods. So that's the point where they should be recording a liability. So forwarding those receiving reports every single day, daily basis, to the accounts payable department. Okay, so that would be a thing that could prevent purchases being recorded in the wrong period, either accidentally or on purpose. And in terms of the classification assertion, was this purchase properly classified? Okay, now they would use, hopefully you got the company using a chart of accounts. Almost all companies are using a chart of accounts. So you have them using a chart of accounts and then checking to make sure that they're properly classifying these purchase transactions. This is not an exhaustive list of every single internal control for purchase transactions. I'm just trying to give you specific examples. Okay, and so here are some examples. For cash disbursement transactions, again, I've got a column, I've got the different assertions, I got a potential misstatement, and then I've got examples of internal controls. For example, to see, okay, so there was a cash disbursement recorded but not actually made. So if they're verifying the occurrence assertion for a cash disbursement, one thing you do is prepare a monthly bank reconciliation. Also, again, I've got segregation of duties, segregation of duties, segregation of duties. I'm telling you, segregation of duties, very important for the purchasing function. Okay. Now, when it comes to accounts payable, right? So if we're thinking about the assertions that management is making about accounts payable balances, again, I've got the assertions here, a potential misstatement, and the internal controls over here. So we'll take a look at, for example, existence. Okay. So the management, so we've got accounts payable here. Normally management, you don't have to worry about management trying to overstate their liabilities, because why would a company try and overstate their liabilities? But as I said, you've got employees who might set up a fictitious company or something like that, or try and pay personal expenses. So it might be that there's a liability that doesn't actually represent the true obligations of the company. Like, it's not a real obligation of that company. It's either a fictitious obligation or it's an obligation of that specific employee. So in testing the existence assertion, see, is this really a liability of this company? Again, only allowing vendors from the approved vendor list, checking for that three-way match, the purchase order, receiving report, and an invoice. Okay, again, that doesn't guarantee there wasn't any fraud, but that's very helpful. In terms of completeness assertion, again, the danger is the company did not record all of its liabilities, right? They understate their liabilities. So the auditor wants to know that this company has internal controls in place to try and check whether all liabilities are being recorded. So if the company's using pre-numbered documents, if they're reviewing unmatched receiving reports and invoices to see, hey, what happened here? In terms of verifying the cutoff assertion, want to make sure that liabilities were recorded in the correct period. So an internal control will be the company making, basically have the company look at the payables that are recorded right at the beginning of the next period, right? And then check those against the dates from the receiving reports and invoices. Basically, long story short, if you see, so let's say the fiscal year end is December 31st, and then all of a sudden the first week of January, so like January 1st, 2nd, 3rd, all of a sudden there's a bunch of accounts payable that are recorded here, like a disproportionately high number. You might say, well, actually, maybe those were supposed to be recorded in the prior fiscal year. And for some reason, somebody tried to postpone them or whatever, and they all got pushed in the next period improperly. So again, the auditor is checking these different assertions, and they're going through a walkthrough, understanding the purchasing process and seeing what kind of internal controls does management have in place. And then the auditor's next step, which we'll discuss in the next video, is to test the effectiveness of those internal controls.